Let's get one thing straight right now. Talking about insurance is not about planning for something bad to happen. It is about taking control. It is about making a powerful, responsible choice to protect the people you love. Think of it as a financial safety net. You work hard for your money, and you build a life for yourself and your family. Insurance is the plan you put in place to make sure that if you are no longer there to provide for them, they will be okay financially. It is a promise you make to your spouse, your children, or anyone who depends on you. It is one of the most fundamental acts of financial love and responsibility you can ever make. Many people, especially when they are young, think they are invincible. They believe they have all the time in the world and that planning for the what-ifs can wait. But I am here to tell you that this is a mistake. The best time to get your financial house in order is right now, today, on July 7th, 2025. Life is unpredictable, and the unexpected can happen to anyone at any age. Having the right insurance in place gives you peace of mind. It allows you to live your life more freely, knowing that a solid plan is in place to protect your loved ones from financial hardship. This is not about fear, it is about empowerment. So, what is this protection we are talking about? In the simplest terms, life insurance is a contract between you and an insurance company. You agree to pay a regular amount of money, called a premium. In return, the insurance company agrees to pay a specific sum of money, called a death benefit, to the people you choose, your beneficiaries, when you pass away. This money can help them pay for the mortgage, cover daily living expenses, fund a child's education, or handle any other financial needs. It's a critical tool for securing your family's future, ensuring they can maintain their quality of life. The world of insurance can seem complicated, with so many different terms and options. But at its core, it breaks down into two main types: term insurance and whole life insurance. Understanding the difference between these two is the first step toward making a smart decision for yourself and your family. Each one serves a different purpose and fits into different financial plans. We are going to break them down piece by piece so you can see clearly which path is the right one for you. You must be an active participant in your own financial life, and that starts with knowledge. Let's start with the most straightforward and affordable option: term life insurance. Think of it like renting an apartment instead of buying a house. You are paying for protection for a specific period of time or a term. This term could be 10, 20, or even 30 years. If you pass away during that term, the insurance company pays the death benefit to your beneficiaries. It's as simple as that. If the term ends and you are still alive, which is what we all hope for, the coverage stops. You can often renew it, but the price will be higher because you are older. The primary purpose of term insurance is to cover your largest financial responsibilities during the years you need it most. For example, let's say you have a 30-year mortgage and young children. A 30-year term policy makes perfect sense. It's designed to last until your mortgage is paid off and your children are grown and financially independent. The premiums for term insurance are significantly lower than for other types of insurance, especially when you are young and healthy. This affordability makes it an accessible and powerful tool for nearly everyone who has someone depending on them financially. Let's look at a real-life example. Meet Sarah and Tom, both 30 years old with 2 young children and a new home. They have a $300,000 mortgage. They decide to buy a 30-year term life insurance policy for $500,000. This amount would cover their mortgage and provide extra money for their children's education and living expenses if something happened to one of them. Because they are young and healthy, their monthly premium is very affordable. They have peace of mind knowing that for the next 30 years, their family is protected during their most financially vulnerable time. The main benefit of term insurance is its pure, unadulterated focus on protection at the lowest possible cost. It does not have any fancy bells and whistles like a savings or investment component. It is not designed to be a lifelong asset. Its job is to provide the maximum amount of coverage for the least amount of money during a specific time frame. This is why it is the right choice for most people, particularly young families who need to make every dollar count. It efficiently solves a temporary but very large financial problem. You get the protection you need without overpaying. Now, let's talk about the other side of the coin: whole life insurance. This is a type of permanent insurance. As the name suggests, it is designed to last for your entire life, as long as you keep paying the premiums. Unlike term insurance, it never expires. This policy does 2 things at once. First, it guarantees a death benefit will be paid to your beneficiaries no matter when you pass away. Second, it includes a savings component called cash value. A portion of your premium payment goes into this cash value account, which grows over time at a fixed rate, tax deferred. The cash value is a key feature that separates whole life from term insurance. It is an asset you can use while you are still alive. You can borrow against it, or in some cases, withdraw from it. This makes whole life insurance a more complex financial product. The premiums are significantly higher than term insurance premiums because you are paying for both lifelong coverage and the cash value accumulation. This is not just protection, it is also a forced savings plan. It is a long-term financial commitment, like buying a house instead of renting. Consider another example. Meet David, a 45-year-old high-income earner who has already maxed out his other retirement savings accounts, like his 401k and IRA. He wants to leave a guaranteed inheritance to his children, and also wants another tax-advantaged place to save money. For him, a whole life policy could make sense. The guaranteed death benefit ensures his legacy, and the cash value provides a conservative, stable financial asset he can access later in life if needed. The higher premiums are not a burden for him because of his high income and disciplined savings habits. The main benefit of whole life insurance is its permanence and predictability. You know exactly what your premium will be, you know the death benefit is guaranteed, and you know the cash value will grow at a steady rate. It is often used for specific estate planning purposes, such as providing funds to pay estate taxes or to ensure a special needs dependent is cared for indefinitely. It is for people who have a lifelong financial need and have the financial discipline to pay the much higher premiums over the long haul. It offers guarantees that no other product can. So, how do you choose? The decision between term and whole life insurance comes down to one thing: your personal financial situation and your goals. There is no single best answer for everyone. You must look honestly at your income, your debts, your savings, and who depends on you. Do not let an insurance agent push you into a product that does not fit your life. You are the one in charge. Your job is to understand your needs first, and then find the product that meets those needs in the most affordable and efficient way possible. Here is my straightforward advice. For the vast majority of people, especially young individuals and families, term insurance is the way to go. You need to protect your income and cover your major debts, like a mortgage or student loans during your working years. Term insurance allows you to buy a large amount of coverage for a very low price, freeing up your money to pay down debt and invest for retirement in more effective ways, like a Roth IRA. Buy what you need, for the time you need it. It is the most financially responsible choice for most households. When might whole life be appropriate? It can be a valid tool for a smaller group of people in specific situations. If you have a high net worth and need to plan for estate taxes, it can be a solution. If you have a lifelong dependent, such as a child with special needs, the guaranteed payout can fund a trust to care for them. Or if you are a high-income earner who has already exhausted every other tax-advantaged retirement plan and you want a very conservative place to put more money, it could be considered. But for most, it is too expensive and inflexible. Ultimately, making the right choice is about being honest with yourself. Do not buy insurance as an investment. Buy it for protection. Your primary goal should be to get the most protection for your family for the least amount of money. For most of you reading this today, that means a term life insurance policy. Take control of your finances, get the coverage you need, and then focus your energy and your money on building a strong financial future through saving and investing. You can do this. You have the power to secure your family's future. Now go and do it.